Why is gold dropping today? The answer lies in the Fed's hawkish repricing and a dollar at 13-month highs. Gold technical analysis today reveals a bearish structure across all timeframes, with gold support and resistance levels now skewed to the downside. The gold price forecast for the next week suggests further downside toward $3,850 if $3,950 breaks. Gold just did something it hasn't done since November 2025. It broke below $4,000. Not a fakeout, not a wick, a clean, decisive break. Spot hit $3,964. We are trading at $3,999 as I speak, and from a January high of $5,596, that's a 29% drawdown. Here's the thing the mainstream narrative won't tell you. This isn't just gold falling. This is the debasement trade, the entire 3-year macro thesis that carried gold from obscurity to nearly $5,600, cracking at the foundation. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today. Here's my session bias. Strong sell, fading any bounce until proven otherwise. The trend structure is brutal. Monthly, buy. Weekly, strong sell. Daily, strong sell. 4H, strong sell. 1H, strong sell. That's 5 timeframes, 4 of them screaming the same direction. When you see this kind of alignment, you don't fight it, you position with it. Write this number down. $$4025 *. If we break back above $4,025 and close above it on the 4-hour chart, the entire structure resets. Until then, every rally is a selling opportunity. The herd is trapped. Here's the micro insight that matters. At current price levels, more than 200 tons of gold in ETFs are in loss-making territory. That's not a flaw, that's a potential avalanche. Every bounce attracts selling pressure from ETF managers forced to rebalance, from traders who bought the January peak and are now panicking, from systematic funds that are mechanically shorting on the breakdown. The crowd is long and wrong. Let me walk you through the chart from the top down. Weekly time frame. We've broken below the 200-week moving average. That's not just a level, that's the structural anchor that held throughout 2024 and 2025. The 200-week MA is sitting at approximately $4,358. We are $359 below it. That's a massive violation. Daily time frame. The 200-day simple moving average is at $4,473. We are almost $500 below it. Every single major moving average, MA5 at $4,114, MA10 at $4,173, MA20 at $4,262, MA50 at $4,446, MA100 at $4,507, MA200 at $4,358. Every single one is stacked above price. This is what a bearish alignment looks like. Price below all moving averages. All moving averages sloping down. 4H timeframe. This is where the real story lives. The 4H MACD is at minus 111.81. That's extreme momentum to the downside. But here's what most traders miss. Look at the 4H RSI at 30.626. We are flirting with oversold. The CCI is at minus 179.91. Deep into extreme oversold territory. This creates a tension. Extreme momentum down but extreme oversold. Readings. Something has to give. 1H timeframe. The 1H chart shows a classic pattern of lower highs and lower lows. After crashing toward $3,959, we got a small technical bounce, but look at the structure. Price remains below the 1H MA20. That bounce is short covering, not accumulation. Short-term, gold may enter a consolidation phase between $3,960 and $4,025. Key levels you need to memorize. Supports S1, $4,058, broken S2, $4,018, broken S3, $3,947. Current line in the sand resistances R1, $4,170. The old support turned resistance R2, $4,242, the 20-day MA area R3, $4,282, major overhead supply pivot, $4,130. The level that separates a bounce from a reversal here is what most traders miss about this breakdown. The $4,000 level had become more psychological than technical. It was the last line of defense for the bull narrative. Once it broke, the technical selling accelerated. The 200-day SMA break at $4,473 triggered the initial wave, and the $4,000 break triggered the second wave. This is how cascades happen. Now watch the crosser set linkage. Gold is moving inversely to the dollar index, which just hit 101.80, a 13-month high. But here's the nuance. US 10-year Treasury yields dropped nearly 9 basis points to 4.41% on the back of oil prices falling. Yields down, gold still down. That tells you this is a dollar story and a Fed repricing story, not just a rate story. Let me connect yesterday's news directly to price action. The catalyst is the Federation. The latest dot plot showed 8 of 19 FOMC members now expect a rate hike by the end of 2026. The market is pricing an 82% probability of a December hike, with 20 basis points of tightening expected. This is a complete reversal from the pivot narrative that drove gold to $5,600. Kevin Warsh's hawkish stance as Fed chair has been the direct catalyst. The market now believes the Fed will prioritize price stability over financial repression. That changes everything for gold. Here's the narrative web: policy divergence. The Fed is talking hikes while other central banks are hesitating. That drives dollar strength. Dollar at 13-month highs. Gold priced in dollars gets crushed. Real yields. Higher nominal rates plus lower inflation expectations from falling oil prices equals higher real yields. Gold hates higher real yields. It's a zero-yield asset competing with treasuries that now offer real returns. ETF flows. Gold-backed ETFs recorded net outflows of 16 metric tons in May and continued outflows in early June. ING analysts said ETF demand is likely to remain less supportive than it was in 2025. Goldman Sachs cut $500 from its year-end forecast to $4,900. Deutsche Bank slashed its Q4 estimate by 17%. Geopolitical. The Hormuz reopening is pushing oil prices down. WTI crude under $70. Lower oil equals lower inflation expectations equals less pressure on the Fed to pivot equals more dollar strength equals more gold weakness. Crosser set linkage. The S&P 500 is bouncing from the AI sell-off, drawing capital away from defensive assets. Bitcoin is hovering near $60,000. Risk appetite is shifting. Gold is being left behind. MY1 to 2-week directional lean. Bearish, targeting $3,850, then $3,500. The invalidation event? If core PCE comes in unexpectedly hot, that could trigger a short-term dollar pullback and gold bounce. But the bigger invalidation is a Fed speaker signaling a pivot, and with Warsh in charge, that's not happening anytime soon. Do you think gold finds support above $3,900 this week? Comment yes or no. I'm tracking consensus. Most people skip this section. That's exactly where the money is made. Keep watching. I'm giving you 3 strategies, each with exact levels you can trade. These are not vague suggestions. These are sniper entries with defined risk and clear targets. Strategy 1, the sniper, conservative. This is for traders who want the highest probability setup with the best risk-reward entry condition. Wait for a pullback toward the $4,025 to $4,040 resistance zone. This is the broken support level that should now act as resistance. Enter on a 1-hour close below $4,025 after testing the zone. Confirmation. Bearish rejection wick or engulfing candle on the 1H chart. Stop loss. Place your stop at $4,085, above the recent swing high and the $4,058 broken support level. This gives you room above the resistance zone. Target 1, $3,960, the recent swing low. This is a logical first target where profit taking is likely. Target 2, $3,850, the next major psychological level and technical. Support. Risk reward. Approximately 1:3.2 are. What voids the setup? If gold closes above $4,085 on the 4H chart, the bearish structure is invalidated. That would signal a potential short-term reversal to the sniper, conservative, entry, 4025, 4040, 1H close below 4025, stop loss, 4085 take profit 1, 3960 take profit 2, 3850 risk, reward, 1:3.2R invalidation, 4H close above 4.085 strategy 2, the active trader, standard. This is for traders who want to participate in the momentum without waiting for a full pullback, entry condition. Enter on a break below $3,947, the S3 support level from our pivot analysis. This is the current session low. A clean 4H close below this level triggers the entry. This is a momentum continuation play stop placement. Place your stop at $4,010, above the S2 support level at $4,018 and giving room for a fakeout. The logic: if price reclaims $4,018, the breakdown is false. Target 1, $3,850. The next major support zone target 2, $3,500. The long-term structural support from April 2025. Trailing stop rule. Once target 1 at $3,850 is hit, move your stop to break even. Then trail using the 4HMA5 as your dynamic stop. Risk reward. Approximately 1:2.8R to target 1, 1:5.5R to target 2. The active trader, standard, entry, 3,947, 4H close below, stop loss, 4010 take profit 1, 3850 take profit 2, 3500 risk, reward, 1:2.8R, TP1, 1:5.5R, TP2, invalidation. For H close above 4018. Type your target for gold this week in the comments now. Let's see who's aligned. Strategy 3, the aggressor. High risk. This is for traders who can stomach volatility and want to fade the extreme oversold conditions for a quick counter-trend bounce entry condition. Enter on a test of $3,850 with a bullish divergence on the 1H RSI. This means price makes a lower low but RSI makes a higher low. This is a classic reversal signal at a major support level. Stop loss. Tight stop at $3,800, below the $3,850 support. Only 50 points of risk. Target 1, $4,000, the broken psychological level. This is a quick 150-point move. Target 2, $4,025, the first resistance zone. Explicit warning: only for those who can lose small and manage risk aggressively. This is a counter-trend trade in a strongly bearish market. The probability is lower than the other two setups. Size your position accordingly. Maximum 0.5% risk on this trade. Risk reward. Approximately 1:3R to target 1, 1:3.5R to target 2. The aggressor, high risk, entry, 3.850, 1H bullish RSI divergence, stop loss, 3.800 take profit 1, 4,000 take profit 2, 4025 risk, reward, 1:3R, TP1, 1:3.5R, TP2, invalidation. For H close below 3.800 warning. Countertrend, size down. Never risk more than 1 to 2% per trade. No positions through high impact news. And tomorrow we have core PCE, GDP, and jobless claims all hitting the tape. Stops are non-negotiable. This is how you survive to trade the next big move. Let me summarize the single most critical level for tomorrow's session. $3,947. If we hold above this level, we might see a consolidation bounce toward $4,025. If we break below it on a 4H close, we accelerate toward $3,850 and potentially $3,500. Tomorrow's focus: core PCE data. This is the Fed's preferred inflation gauge. If it comes in hot, the dollar rallies further and gold breaks lower. If it comes in soft, we might get a relief rally toward $4,025. But remember, any bounce is a selling opportunity in this structure. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen, smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.